Hello, this is Laura Lau, Senior VP and Chief Investment Officer at Brompton Funds, to give you an update on our dividend growth split share funds, DGS Dividend Growth Split, and GDV Global Dividend Split. Today's date is August 10th, 2020. So this is a summary of Brompton's split share lineup. Brompton is a leader in split shares in Canada. The first in our lineup, which is also the newest member, is GDV Global Dividend Split. It's the only global dividend split in Canada, and we just announced our 3 to 5 year extension for the split and the preferred share. DGS Dividend Growth Split, which is the most diversified of our Canadian splits, which is a portfolio of Canadian dividend growers. Split Bank Corp, SBC, which is the big 6 banks. We have Brompton Life Co. Split Corp, LCS, which is the big 4 Canadian life cos. LBS, Life and Bank Split Corp, the big 6 banks and 4 life cos. And Brompton Oil Split, OSP, North American Oil and Gas Issuers. So this is a reminder that the Class A dividends we pay out are tax-advantaged income. They're typically in the form of return of capital and our capital gains. So for GDV, it's typical return of capital and capital gains. For DGS, we're not currently paying a distribution. The distribution will be reinstated when the Class A NAV is over $5. Class A NAV is currently about $3.67. So our split is made up of a preferred share, and the remainder is the capital Class A share. Brompton's preferred shares are in great demand since they have outperformed traditional preferred shares. It's actually been a very difficult market for preferred shares in Canada due to the rate reset preferred share market. But ours are different. They're not based on a fixed spread. They're actually retractable. So at the end of the term, if you don't like the rate, you can give them back to Brompton, and that's why they've outperformed. Typically, what we do is we make sure that the rate is repriced, that is at a competitive rate to existing preferred shares. So as you can see, this is a graphical format. The Brompton prefs are in dark blue, and they've outperformed the S&P TSX preferred shares that are in bright yellow. And especially on the downside, you can see that they performed well. So let's just start with, investment overview. We've seen unprecedented central bank stimulus. We've also seen unprecedented fiscal stimulus from COVID, and we've also seen the economy is recovering from the initial shutdowns for COVID, and we believe we're starting a new bull market. And we also have seen that dividend growth equities have historically outperformed the broader market. And Brompton employs an active covered call strategy to enhance income and lower volatility of our portfolios. So first of all, central banks. This shows on the left-hand side is a percent of GDP that we've seen as the central bank balance sheets. And you can see the gray line is the Bank of Canada. So the Bank of Canada, we've lowered rates to about as low as we can, and the new Bank of Canada governor said rates will remain low until 2023. So this is our first quantitative easing in Canada. The blue is the Fed funds, the Federal Reserve, and as you can see, this is actually the fourth quantitative easing, or as people call it, QE infinity. We don't believe that printing will go on infinitely, and we believe it will slow down at some point. And then the yellow is the European Central Bank, and they're printing money as well, and interest rates are negative. So the charts for the Bank of Japan and Bank of England are actually very similar. And we've also seen unprecedented government spending. So what this chart shows is, the response for COVID in terms of this encompasses spending, loans, loan guarantees, and other backstops by the government. And as you can see, all the major countries have been spending a lot to bridge that gap until things get more normal with the vaccine. And I'd say one of the most notable ones would be Germany. Germany in the past has really feared inflation after they've seen substantial inflation after the world wars. And in the past, they have refused to do any deficit spending. But you can see that now they are one of the biggest spenders for COVID. And the economy is starting to recover. These are the GDP numbers for 2019 and projections for 2020 and 2021. Due to COVID, there was a sharp drop in 2020, particularly in the second quarter where most economies had shut down. But we're starting to see a lot of the leading economic indicators are bouncing back. And we do believe we're making progress on COVID. We've learned a lot since the outbreak occurred. We're learning how to treat people. Do you need a ventilator, oxygen? We actually have 2 approved treatments. And now we're producing enough protective equipment. But the most progress I think we've seen is on vaccines. We've seen many trials. And in Canada, we've signed deals with 2 companies, Pfizer and Moderna. And this is the fastest we've ever seen vaccines being developed. It's typically a 7 to 10 year process. So we expect a vaccine for widespread distribution in 2021. As a result, we expect most economies to recover next year. We believe that a new bull market has started. So typically, a bull market is defined as a rise in the market of at least 20%. And this does typically occur after a big drop of 20% or is a bear market. This was a very vicious bear with a drop of almost 34%. It's been the fastest drop in history. And the S&P 500 has been up about 51% since the March 23rd low. Bull markets do tend to climb a wall of worry. So what this chart shows is 7 times since the 1960s when stocks, the S&P 500 have gained more than 43%. And as you can see after this large gain, the market may correct, but the drops are not big since we are at the start of a new bull market. Typically, one good strategy for bull markets is to buy the dips. So you can see the maximum decline after 1 year gain, that 43% gain, you can see that's the last column. The biggest loss was in the 1960s, negative 14.6%. All the other bull markets hadn't really even seen a 10% decline, which is what we would call a correction. So if people are waiting for a correction, it may not come. History has shown that there may not be a correction. But we do expect there could be drops, especially with the volatility surrounding the upcoming US elections. But as I said, we don't expect them to be big. The worst is over. The economic indicators, coincident and leading, have hit rock bottom and they've jumped up. And when the Fed cuts, usually that is good for markets. The saying is don't fight the Fed. So in general, performance has been good after a big rally. As you can see, after 3, 6, 12 months after the rally, the market does tend to go up. So how do you invest? We believe that this shows on a global basis, MSCI World Dividend Masters, which are basically portfolio dividend growth stocks, versus the MSCI World Index, which is more the broad index. Dividend growers, they tend to be high quality companies. They grow revenues, earnings, dividends, and they tend to have low debt. And due to the income component, you can see they tend to have lower volatility because it helps lower the duration of the portfolio. And especially in a low yield environment like now, they tend to outperform. So as you can see, the MSCI World Dividend Masters Index, the dividend growers tend to outperform, better returns, lower risk. So definitely superior risk adjusted returns. The Global Dividend Growth Split Corp basically follows a dividend growth strategy. It's the only global split on the market. We buy a portfolio of blue chip dividend growth companies with a market cap of at least $10 billion. The preferred pays out 4.8% coupon with 47% downside. The Class A pays 12.2%, primarily in return of capital and capital gains. So both give you tax advantaged income. So in terms of positioning, you can see where we're overweight. We see the most value in financials. This is not the great financial crisis. Valuations are at great financial crisis lows, but the fundamentals are actually better. In energy, even though it looks like we're overweight, we only have pipelines. We don't have E&Ps. And with pipelines, most of the volumes are contracted. We see demand returning with oil and gas prices stabilizing, and they have high sustainable yields. We're also overweight industrials where we see the economy improving and they're one of the biggest beneficiaries. And discretionary, we see consumer spending improving. And even though we're underweight info tech, we have companies we do consider tech companies in other sectors like eBay. These are some of the portfolio metrics. You can see GDV is comprised of blue chip portfolio with attractive dividend yields with larger market cap than the index and better historical dividend growth. These are just some sample of companies in the portfolio. Some you would have heard of like Apple, McDonald's, Lowe's, and Target. So we expect some companies like McDonald's, Targets, and Lowe's to take market share from smaller companies, especially mom and pops and mid-sized companies in this post-COVID world. We also see another trend to go more green. And with that, we have Air Products, which is industrial gases, hydrogen, which is one of the fuels for the future. Also Schneider Electric, which builds more efficient buildings, and Enel, which generates green power. In terms of hygiene, in this post-COVID world, we also believe that we'll be using more sanitizing cleaners, and that will be a theme going forward. So with that, we have Clorox for Clorox bleach, and that little pink RB, you probably are not familiar with it. That's Reckitt Benckiser. But I'm sure many of you have used their products, Lysol wipes, that have also benefited from COVID. Certainly things like vaccines and treatments. We have AstraZeneca, who the WHO believes their vaccine is the number one candidate right now, and Sanofi, who is also a leader in vaccines. So the Canadian market, we do believe, is undervalued. Stocks been trading at a discount, whether on a PE, price to earnings basis, or equity risk premium basis. The Canadian market is very a value market, heavy on financials and energy. With the economies improving, we do expect these stocks to start doing better, especially since they are trading at such a substantial discount to their intrinsic value. Again, this is a sector breakdown of the dividend growth split. We have a diversified portfolio with about 37 securities. Currently, we're overweight utilities. We're underweight technology because there really are very few dividend growth stocks in Canada in technology, and also underweight materials for similar. There are more dividend growth companies in the material space, but not a lot either. So what this slide's showing is what happened in Canada. So the TSX ended up only down 3.2%. But if you actually look at this, this shows the contribution for every single sector to that negative 3.2%. So the blue bars are the positive contributors, and the yellow bars are the ones that negatively contributed. So you can see the biggest contributor was technology. So technology was really one stock. It was Shopify. So Shopify we actually cannot own. Shopify does not have a dividend. In order to qualify to be put in the portfolio, it needs to have a dividend, and the dividend has to grow, or we believe it's going to grow. So Shopify has become the biggest company in Canada, bigger than Royal Bank. It was up 165% year to date. So the second biggest contributor in terms of performance was materials. Materials were up 30.5% year to date. And it's mostly golds, because golds are up almost 55%. Materials are now almost 16% of the TSX. We have selectively added some dividend growing gold stocks in Canada as portfolio insurance. We see quantitative easing going on indefinitely. It's a good hedge for COVID. We do expect another fiscal package from the United States and election uncertainty. You can see also that energy, which was the worst performing sector, contributed negative 5.2%, but the biggest detriment was financials, even though it was the second worst performing sector, but it is a large weight. The combined portfolio was down a negative 8.7%, so it actually outperformed considering we could not own Shopify, and it's actually difficult to own such a gold weight because this is a conservatively managed portfolio. Those of you who remember the old DGS static portfolio, 65% of it was in financials. Now it's only 26%. The portfolio would have been down substantially more since financials were down 18% year to date. Banks were down 15%. So the performance in the portfolio was helped by some of the new sectors and companies we've added. So we've increased weights in things like utilities, and we've also added new sectors that had performed well, such as consumer staples, real estate, and industrials. This is a summary of the portfolio characteristics for DGS. As you can see, the companies tend to be larger, we have a better dividend yield, and better historical growth. This is a sample of some of the companies we have in the portfolio. Since we've modernized the portfolio, we've added some more. We've increased the utility weight to about 10%. We've added Fortis, Emera, and some of the greener companies such as Northland Power and Algonquin. We previously had no staples. We've added Loblaws. We've seen increased business for grocers during COVID. And previously we had no real estate weight. We've added Cap REIT, which is a residential REIT, and Granite REIT, which is a warehouse REIT, because we've seen a lot of growth in e-commerce. We have an active covered call writing strategy in both of these portfolios. We manage over 1.4 billion in covered calls in 13 Canadian and global mandates. So the idea is that we use the covered calls to generate income and also to reduce the overall portfolio volatility. We do that tactically to generate additional income and harvest the volatility in the portfolio. We use this income to help cushion the downside. You see myself on the left, and then I'm helped by my team. I'm assisted by the other portfolio manager, Mike Clare, and we have two investment analysts, Maggie Mung and Varun Choya. These topics that I discussed may have contained forward-looking statements. Further, I'd like to reference today's date of August 10th, as some of these topics may be time sensitive, and you can see the performance on the bottom. And here is our contact info. If you have any further questions, please contact us at 1-866-642-6001 or email us at info@bromptongroup.com. Thank you very much for listening.